Hi, good day, Doctor, and our fellow classmates. We are from Group 2, and we will summarize the case study about Boston chicken. Also, we will provide some suggestion and recommendation relating to issue that we have identified from the case study. Here was our group mate, Ong Jing Si, Siming Xuan, Pang Jiahui, Coron Chen, and I, Zeng Yun Wei. Now, move on to the part 1, the case summary. We will discuss the company background, company structure, growth strategy, expected future performance, and also the result of operation. Let's discuss the company background and concept. Boston Chicken, founded in 1989 by Scott Beck. The vision was clear: to create a dining space that not only serve delicious meal with a focus on rotisserie cooked chicken, but also offer a warm, homey atmosphere. The concept was unique. More than just food, it aimed to deliver a distinctive dining experience reminiscent of traditional home cooking. For the company structure, we will focus from 1991 to 1994. In this slide, you can notice that the store, the revenue, the net income, and also the share price of Boston Chicken has totally increased. The store is from 34 store to 534 store, and for the revenue is soared from 5.2 million to 96.2 million dollars, and for the net income is increased from 2.6 million deficit to 16.2 million gains. And lastly, for the share price is soared from $10 initial offerings price to a high of $26.5. Last for my part, I will discuss about the company growth strategy. The first strategy is area developer organization. Boston Chicken strategically partner with seasonal regional developer committed to establishing over 50 stores, offering a franchise agreement with a one-time fee and royalty and revolving lines of credit upon 75% of equity investment. The second strategy is communication infrastructure. A significant investment, $8 to $10 million, created a comprehensive computer program seamlessly connecting Boston Chicken operations for enhanced efficiency and communication, showcasing the company commitment to technological advancement. The third is new market development. Fueling expansion, Boston Chicken enlisted over 180 professionals to meticulously select new sites, ensuring growth aligned with the company's high standard. These seasonal teams became the architect of Boston Chicken future. And the last is operating improvement. In 1994, Boston Chicken expanded operations, securing top-notch ingredients through intricate suppliers negotiation. The addition of satellite unit transformed food preparation into an immersive experience, and expanded menu and innovations like touch-activated terminals and drive-through lanes showcase the company's commitment to personalized convenience and customer-centric dining experience.
Thank you, Linwei and Junshi. We'll continue presenting the expected future performance and results of operation of Boston Chicken. In late 1955, it's showing two different views on Boston Chicken's future performance. As compared to the beginning of the fiscal year, there was more than 100% increase in stock value as optimistic investors like Michael Moore of Lehman Brothers saw it as a strong player in the home meal replacement and value market. However, there are also pessimistic investors like Roger Lipton of Lipton Financial Services, who claims the franchises are losing money due to their lower sales compared to the operational cost. There was total 10 million shares short interest positions in the market, which is being doubled. Going to the operational result analysis, Boston Chickens earned 126% increase in its total revenue, which mainly contributed by royalty and franchise-related fees, and profit of company-operated stores resulting from a higher average numbers of stores. Since there were high numbers of new opening stores with purpose to seed new market, the cost of goods sold had increased 41% because of high costs from free food testing, inefficiency of inexperienced employees, and poor daily production needs for forecasting due to lacking operational history. Not only that, The increase of total employees in both supporting center and new company-operated stores had increased the total salaries by 47%, while high investment and strong development in company's infrastructure brought an increase of 101% in general and administrative costs. In 1944, the company spent $268.1 million for its store development, including financing for area developers, purchasing real estate, and open new stores, while $52.3 million spent for the property and equipment infrastructure investment, as well as software development. Since the company purchases and resells market stores to area developers to facilitate the consolidation activities, the timing of such transaction will bring impact to the size and timing of capital requirements. Hence, financing activities are important. In 1944, it carried out few financing activities and gained a high amount of capital through private or public market, including $35.9 from profits from operating activities, $113 million from issuance of convertible subordinated debentures, and total $125.7 million of share selling. In case the company anticipates an increase in the financing requirements, they will seek additional financing from both private and public investors market to meet with their capital requirement. That's all for the case study summary. Next, I'll pass to Yungshen for further discussing its challenges and recommendations. Thank you.
A very good day to Doctor. I'm Yungshen and I'm going to discuss the related issues and recommendations for Boston Chicken. The first issue we identify is lack of allowance for loan default. So the allowance for losses is the assessment of management, consider financial status of each area developer, store performance, and various other factors to account for potential loan losses. So throughout our review, there are no allowance made in 1993 and 1994. So the discrepancy in reporting stream from Boston Chicken representing that the franchise as independent entities. So this approach enables Boston Chicken to manipulate their financial performance and conceal franchise losses. Furthermore, Boston Chicken expressed confidence in their developer full repayment of the loan. However, it's imperative to acknowledge that credit risk, and Boston Chicken had the responsibility to transparently communicate the inherent risk in its debt financing to its shareholders. So the absence of allowance account for credit risk implies that Boston Chicken may potentially overstate its financial performance. To improve the accuracy of the financial statement, we will suggest that Boston Chicken financial statement should include the losses sustained by their franchise, since they have a substantial ownership stake. Additionally, the provision allowing Boston Chicken to reflect the potential risk of not receiving full payment on loan and help them to adjust the reported financial figure accordingly. For illustration, so we set the allowance of the bad debt at 10% for Boston 1994 net income. So it reduced around 20 million of Boston assets, and also the net income experienced a corresponding decrease of 15 million, stemming from an operating loss of 175k. So therefore, the allowance for loan losses must take into the account to avoid any inaccurate assessment.
Good day to Doctor and everyone. I'm Rong Chen. I'll be presenting the second issue, which is the misleading of income statement. The foundation of Boston Chicken business model is franchising. As franchises provide the majority of the company's revenue, includes the royalties, fees, and interest. In fact, the majority of its assets are used to support these franchises who obtain loans from Boston Chicken. And in order to penetrate to new markets, even the little portion of the company that runs its own restaurants, which is roughly about 8% of all the stores, plans to become a franchise too. The problem is that Boston Chicken's profits are highly reliant on these franchises' ability to make payments. There is an additional degree of uncertainty due to the possibility that franchises will not fulfill their duties and the revenue from franchising cannot be repaid to the external funding of Boston Chicken. And still, the financial reports don't provide the complete picture. They only display the revenue received from franchises, but they do not display the true expenses and losses that these companies bear. It is mainly due to Boston Chicken is effectively supporting its own success, which is the positive performance indicator such as an increase in the earnings per share, which is the EPS, may therefore to be misleading to the stakeholders. So for the subject, in terms of suggestion, it is recommended that Boston Chicken updates its earning reports to reflect both the revenue received and the cost borne by the franchises in order to resolve the problem. And additionally, The corporation needs to account for possible bad debts on the notes receivable that were issued during the fiscal period. In this case, it will avoid misunderstandings among investors and other stakeholders and provide a more truthful picture of how the company is doing rather than misleading the stakeholders in the context of company is doing all good. And that's all from me, and I'll pass it to the next presenter as well.
Good day to Doctor. I'm Jiahui. I would like to bring your attention to the last financial challenge faced by Boston Chickens, a situation marked by a significant 41% surge in the cost of product sold, as outlined in the Appendix 2. The primary factor behind this surge was the ambiguous expansion strategy involving the opening of company-operated stores to seed new markets. The rapid scale-up led to a heightened cost attributed to food usage for testing, operational efficiency from inexperienced employees, and a lack of the store-specific operating history to guide daily food production needs. To resolve such issues, a strategy focused on comprehensive employee training became paramount, particularly for the food and beverage company where production largely varies on skilled employees. Investing in training programs for new hires before store opening is crucial to mitigating inefficiency from inexperienced employees. A well-trained workforce not only contribute to smoother operations, but also play as a key role in implementing a constructive cost management system, emphasizing a robust food cost management approach, leveraging first in first out before storage become essential to minimize food wastage. Implementing a daily tracking of the variance between actual and theoretical food costs allows for proactive adjustment against benchmark, preventing variance from reaching critical levels. Furthermore, an effective inventory management system is crucial to monitoring dairy food production needs, offering insight into the ingredient usage, identify leftover, and ultimately trimming the unnecessary food costs while reducing waste. So this holistic approach positions Boston Chickens to enhance their cost efficiency and also the operational effectiveness. So come to the end of presentations. Thank you for your attention.